Could AMC and APE both squeeze at the same exact time? That is what we are going to talk about here in this video, and how in theory it is possible. So first things first, APE, AMC, one is a preferred equity. Basically, if the business were to go bankrupt, you would want to own APE instead of AMC. So on one extent, those preferred shares might be more desirable, even though we don't know every last detail of if these shares will actually be convertible to AMC or not. But what has been happening over the last couple of days that we have been trading APE shares is that some days APE is up and AMC is down. Some days AMC is up, APE is down. Now, I don't necessarily think a big reason why AMC fell 42% just a couple of days ago was because of the actual split effect. Because in all reality, if it was due solely to the split, you would have dropped, what, 50%, right? Because you just got your shares back. And at one point, you had a big net gain on your position by 5 to 10% at least. And that didn't last very long. But what really caused all of that was Ryan Cohen selling out of BBBY. It was the bad news about Cineworld. That's very big, because let's say you had an Intel, just for an example, just going off of different industries here. Let's say you had an Intel that said, yeah, guys, we might go bankrupt. Well, that's going to hurt AMD. It's going to hurt NVIDIA by probably 10 to 20%. And those are much quote unquote sturdier companies than something like AMC or the movie theater industry. So some people have talked about that drop and the subsequent negativity in AMC shares has been due to the actual split. I would argue some of it has been due to that, and some of it has not been, like I just said. So what's happening today with AMC and APE? Well, AMC is up 1.52%. It was up closer to 3%, hitting a high of almost $10 per share at $9.90 per share. And APE has pretty much been up 3 to 4% for a vast majority of the day. So this is very similar to Goog and Google. These are preferred shares compared to the normal shares, and they do tend to rally together. If we pull up a daily candlestick chart on Goog and Google, I mean, they virtually look the same, right, as they should. And I think this could play out somewhat to the same degree of AMC and APE. At the same time, it gives you more flexibility owning both, in which I think you should own both. I don't think, and this is not my choice to make, but I don't think it's logical to own AMC or just own APE, because simply due to the fact of they were free shares, and technically if you sell out of APE, you sold out half of your AMC position. But nonetheless, I do think it is very, very possible that these two could really feed off of each other. If AMC gets a higher and higher short interest, in which it has been, now the short interest sitting at 20.24%. Short interest of free float, and the free float out on loans sitting at 33%. If these numbers continue to go higher, as well as the cost to borrow numbers, in which we'll talk about in just 1 second, at the same time APE short interest is climbing, then I definitely think you could get the two feeding off of each other, and I do think you could see bigger rallies based off of that. Now, the dollar amount currently sold short of APE is about 51 million. Current short interest of free float at 1.42%. So very low nonetheless in regards to AMC. Cost to borrow max at 35%, cost to borrow average at almost 18%, and cost to borrow minimum at almost 12%. If we look at AMC, cost to borrow average at 23%, cost to borrow max at 35%, and cost to borrow minimum at 12%. So I do think they will feed off of each other in some way or the other, and I don't think this opposite correlation will really last too long. In theory, you shouldn't have an opposite correlation to the normal shares and the preferred shares. Maybe the preferred shares perform a little bit better, but it shouldn't be a big difference there. You shouldn't have an up 5% day and then a down 5% day on AMC. That in theory should not happen. So we'll see, over the next coming days and weeks. But really, does this change the potential to see a gamma squeeze in either one or both of these securities? And really, the answer is no. Not at all. This is actually a very bullish thing in my opinion, and I plan to double down on AMC as the short interest has climbed, as we are, hopefully getting out of the danger zone on a fundamental basis for AMC or for the theater industry in general. Who knows what's going on with Cineworld? That's a whole different can of worms. They were unable to raise capital in the same way that AMC was. But long story short, am I still bullish here? And the overwhelming answer is yes. And if you are bullish on AMC, then I think why would you not look to get some positioning now? I think it's common sense, right? So I think that's a key a lot of people need to understand, is that both of these stocks could rally at the same time, and more specifically go through different degrees of short squeezes, and they could actually feed off of each other. And that's something we will wait and see if that actually does start to happen. As far as the option activity for the day, you are seeing a lot of calls coming through. 81% positive order value, worth $110,000. 3 orders in total. It looks like there's 4 right here. I don't know if some orders are just coming through right now, but we do have some catalysts throughout the rest of this week that will affect both AMC and APE. The first one being really not a huge catalyst in the grand scope of things. It's kind of like a good and a bad, but Biden cancels $10,000 in federal student loan debt for most borrowers, and I think that's mostly a positive thing. Inflation, that's probably not going to help too much, and that's what you're going to hear people talk about, is that will help inflation remain high. So in one sense, good for the overall consumer, right, to have $10,000 of debt removed from the federal government. I mean, it's not a terrible thing for actual people, but it might be construed to a negative thing for the stock market, for potentially inflation and the economy. Now, as you guys do know, we have Jackson Hole today, tomorrow, and Friday. We also have a lot of data as well. And from what I'm hearing, and the Jackson Hole event, we're not going to hear from the Fed until Friday. That could be wrong. We might get some statements here and there, and that's something that will be the biggest catalyst of this week. But on top of that, we can't forget the U.S. just economic data in general that will be coming out over the next 3 days. So today, you got durable goods orders month over month for July. That didn't come in too bad. Pending home sales down about 1% month over month. And I guess, quote unquote, from CNBC, some realtors are talking about the real estate market is hitting a floor, hitting a bottom. Well, I'm a licensed real estate agent, and that is absolutely not the case. We have not even seen the full effects, not even half the effects of 6%, 7, 8% mortgages in some cases with lower qualified borrowers. But nonetheless, for tomorrow, and this is when you might hear a couple statements from Fed Powell, you do have 8:30 in the morning GDP growth rate quarter over quarter for the second quarter, and this is the second estimate. You have corporate profits, you have initial jobless claims for this last week, and the second quarter second estimates for core PCE as well. That will be important, but Friday is really going to be the big day, because at 8:30 in the morning you have personal income month over month for July, personal spending month over month for July. 8:30 in the morning, goods trade balances, wholesale inventories, PCE price index year over year, PCE price index month over month. All of that coming out at 8:30 in the morning. And then you have the Michigan Consumer Sentiment Survey, the final survey for August, coming out at 10 in the morning. At the same time, you should be hearing from Powell a couple times on Friday. And just so you guys know, this is the last weekend of August. September tends to be a very bearish month historically. So I do think there is that chance that coming on Friday, people might start to panic. Trading algorithms might actually start to panic as well, just due to it's a weekend cyclicality of the markets and how September tends to trade. Like the average market return is down like 1%, which is pretty big over a 50-100 year average, right? And given the state of the markets right now, I mean, there's half the people in the markets think the Fed's going to U-turn, half the people in the markets don't. And stocks are still trading at almost record valuations. Not the small caps, not the mid caps, but the large guys, your Apples, Microsofts, Googles, Teslas, even Nvidias, right? These guys are trading at near all-time highs as far as price to earnings ratios. And that's not going to be good if the Fed puts a dampen on expectations and what the Fed is going to do, right? We're going to get a lot of new information if the Fed plans to stop raising rates by 2023, right? Or if they plan to pivot, or if the economy is just so good and they're so worried about inflation that they're just going to keep raising rates for a long time. Maybe the neutral rate they want higher, right? Or maybe on a more bullish case, I guess you could say they move the inflation target from 2% maybe to 2.5% or 3%, right? We'll have to see how the markets would react to that information, but those are all possibilities, and those would all cause big market reactions. And to put it simply, we have not heard from the Fed since they caused this major rally in the stock market. Just if you look at the S&P 500 going from 362, or even during the last meeting at like 390 all the way to 432 and peaking out and coming back down just a little bit. The Fed caused that whole rally by unscripted comments. If the Fed wants to talk it down, well, that is exactly what they are going to do. And another big story is going to be earnings. You have NVIDIA earnings, Salesforce, Snowflake, Autodesk, Splunk, Williams-Sonoma, Box, Victoria's Secrets, NetApp, and Guess that report earnings here in after hours. Guess what's going to be the biggest? Well, you probably already know it's going to be NVIDIA, depending on how NVIDIA reports earnings and what they have to say about potentially chip demand and processors, graphics cards, all of that good stuff. That will definitely move that stock around a lot, and will probably, if I were to imagine, move the markets around a lot as well. So those are the big things to watch for today heading into the rest of this week. If we do take a look at AMC on a technical basis, I mean, the stock's down in the ground. It's due for this bounce. We hit a low of $9.23 per share. The low of 2022 was $9.70 per share before this. So you definitely want to see if we continue to fall under, in a significant way, if we just continue to fall through the floor, which I highly doubt, or if, like we see right now, AMC's trading at $9.71 per share, if we can hold that level, which is going to be this blue line, in which it looks like we are doing so far for the day. So long story short, this situation could be a lot worse on a technical basis, believe it or not. We're actually bottoming out after the split and after, just getting the free shares. You're still bottoming out at the low pretty much of 2022 that did happen back in July. So like I said, I think it could be worse, and I think if you wanted to be bullish on AMC, I think now is probably your best time to get a position, as long as the Fed does not derail a potential rally. And I would expect APE and AMC to somewhat go through a short squeeze together when the MOAS does happen. So that is pretty much going to be all for this video. Hit that like button and subscribe to the channel. Comment your questions, concerns, thoughts, all that good stuff down below in the comment section. If you guys want to come trade with me live in real time, link down below in the description of this video as well. You guys enjoy the rest of your day, and I will see you in the next one.